Okay, chapter 15 talks about the term structure of interest rates. And the term structure of interest rates, the most interesting thing about it is it kind of gives you a precursor to what's going on in the economy. So the chapter overview is the yield curve, interest rates under uncertainty and certainty, the theories of term structure, interpreting the term structure, and a little bit on forward rates and contracts. So let's talk about the yield curve. So yield curve is a graph that displays the relationship between the yield to maturity and the time to maturity. The yield to maturity is going to be an interest rate, and time to maturity is going to be obviously a time. The information on expected future short-term rates can be implied from the yield curve. So here we go. If we look at this, there's four different yield curves here. They have a similar scale, although it's not exactly the same. Again, remember to read your scales. Across the bottom is always 30 years, so we're pretty clear on that, even though the month is different. So read your scales, because it's misleading to have the different scales there, and it can really make you make mistakes. So this is January 2006. This is a flat yield curve. In 2012, we have a rising yield curve. In 2000, we have a falling yield curve. And in 1989, we have a little humped yield curve. So these are indicating different things. This is short-term to long-term, and these are the interest rates along the vertical axis. And so a flat yield curve says that the future rate of interest will be the past rate of interest. And so we think to ourselves, what does that mean? Is that the economy getting better or is it getting worse? Well, if you think about what was going on in 2006, the economy was doing pretty good. Interest rates were fairly high in the short end, 4%. In the long end, they were also being pushed down. Well, if interest rates are down, bond prices are up. That's right. So if the yield in the short term versus the long term, we'll talk about this later in why this happens. So we want to talk about expectations, hypotheses, and liquidity preference, etc. But when we think about this, if you can get 4% short term, why would you tie your money up for long term? There's a lot of risk there. So when you take just short term. So maybe this was an indicator of, more people being in the short term. And of course, the short term, the Federal Reserve has a lot to do with the short term interest rate. More typical yield curve is short-term is low interest rate, long-term is higher interest rate. And so this is a normal yield curve. It's usually more sloping than this. This is kind of flat and being pushed down and then very steep. But even so, a yield curve would be normal to have lower interest rates for short yields of maturity and higher interest rates for higher yields of maturity. And this is 2012. And of course, we were seeing a pretty good recovery in 2012. Not great, robust recovery, but recovery. And so that was an expected yield curve. The Fed had pushed interest rates way down. The longer end of the curve had gone up a little bit. In 2000, September 11, 2000, this is obviously September 11th is a day we'll always remember, although 2000 was a little early, 1 year early, of the disaster. But we've got September 11, 2000. Well, this was the dot-com crisis. So we had high interest rates, and the interest rates on the low end, and the low end here, had fallen. Well, what does that tell us? That means that interest rates went down. If interest rates went down, what happened to bond prices? Bond prices went up. Well, the only way to get bond prices up is if people started buying bonds. And so why would people have bought bonds? Because in March of 2000, the market hit the top of the dot-com peak, and they started moving out of equities and into bonds. So the yield curve fell, and you've got this downward sloping yield curve, and people were moving out of equities and into bonds. So bond prices went up. And yields went down. And so you can see that yields went down. Instead of having a normal facing yield curve, you got more interest rates on the short term than you did in the long term. Now, obviously, that's going to change over time, as it did. And in the hump yield curve in 1989, this was after the financial crisis in 1987, we had very high interest rates compared to today, as you can see at 8%. And in short term, they went up quite slightly, and then they fall off. But remember, this is 8.4 to 8% interest. These other ones are changing. This is 0 to 3%. That's quite a dramatic change. This is 6% down to 6.25% down to less than 6%. So it's about a 0.5% change here. And this one is about a 0.5% change here. So the normal yield curve will have 2-3% in it. This is barely 0.4 point. So that's almost flat. You could say it's almost flat. So when you start thinking of yield curves, if it's a normal yield curve, the economy is doing fine. We're all in a normal mode of equities are doing fine, bonds are doing fine, there's no panic. When you see an inverted yield curve, as you see here, where short-term rates are higher than long-term rates, that's a big signal. Here comes a recession, here comes trouble. Why? Because the bond market is moving, because people are moving their money away from stocks, which is where you want to be for risk. If the economy is doing good, you want to be in stocks, but they're moving away from it into bonds. And the reason they're doing it is because they feel something in the economy is not going well. So if the interest rates are falling, that means the bond prices are rising. Bond prices are rising because the demand for bonds is higher. The demand for bonds means they're pulling out of stocks. If they're pulling out of stocks, therefore the economy is shaky. And the bond market is all professionals. There's no amateurs in the bond market. It's all professionals. These are people trading institutional money. And if they're moving away from it, we should listen to their signals. This isn't something you'd see on a Jim Cramer TV show. We're going to start moving the bond market or selling a stock like Apple or something that anybody could get into. The bond market is all professionals. And if they give a signal that they're scared of the equity market, we should pay attention.